So question 1 is your normal question 1. So this is what you expect to see in the resit exam. It's a sole trader who's got a business and they will give you a trial balance. Now the trial balance represents what the sole trader has already accounted for. As you can see, the trial balance balances, which means that they've done all their entries correctly. And if we look at trial balance, just to remember your rules of your dead click, all right, dead means debits are increases and expenses, assets or drawings. So if you go down your list here, everything you've got here will either be an expense, an asset or a drawing. And then the click represents credits. So credits are increases in liabilities, income or capital. Again, if you go down your list, you'll see that those all apply. So you've done your double entry, you've balanced off your ledgers and you've put them into your TB. Anything you've got in the notes here, so where it gives you some more information, that means you've got to do the double entry. So for each of these things that you've got in your list, you need to consider what the debit and the credit is. Now, we're not going to be giving marks for telling us what the debit or the credit is, so you don't have to write that down unless you find it useful to do your workings. We just want to know that really you know where to put these into the financial statements when you're preparing them. So if we look at the requirements, it's a normal situation: prepare a profit and loss for the year end and then a statement of financial position as at the 31st of December. It's pretty much even marks for both of these. So that gives you your 50 marks. Right, the first thing I'd expect you to do then is in your exam to set up your pro formas. So we're going to do a heading for each of the statements we're preparing. So we're doing a statement of profit or loss. Then we want a heading, and the question is for somebody called Bally. We look here. Bally runs a gardening business. Okay. And then we want the year, and it's year ended December 19. Now, a lot of you who may not have passed the main exam, or maybe some students who just scrape it through, they do forget this heading, and you do get a mark for presentation. So to get your presentation, we really want 3 things in it: the name of the statement, the name of the person that you're doing the accounts for, and a date. And it is important that it's a year end date, not an as at, because a profit and loss is a statement for the year. It's saying this is what's happened this year. It's not a cumulative statement, it's a snapshot for a particular year in time. Now, the next thing I expect you to do is to draw up your structure. So you'll have your sales at the top, then leave yourself a bit of space, put heading of cost of sales, and you can use that abbreviation. Then a little bit of space, put your gross profit in. Little bit of space again, and then put your heading less expenses. And then right at the bottom of your page, you should have net profit. So this should take a whole page up in your answer booklet. So just space it out as I've done. So sales, cost of sales, gross profit, expenses, and net profit. Then you're going to do exactly the same for your SFP. Okay, so statement of financial position for Bally, and then this one says as at 31st December 19. So we've got the same 3 things in our heading. We've got statement name, name of the person, and we've got a date. All that's really different is the date is as at, whereas for a profit and loss it says year ended. And that's because your SFP is a cumulative statement. Now, this should also take a whole page in your answer booklet. So we're going to start at the top with the heading non-current assets. Leave yourself some space. Heading for current assets, a bit more space. Heading of capital. Then we've got non-current liabilities, and then finishing off with your current liabilities. So you can use abbreviations as long as it's something like this that we obviously recognise as being the correct heading. So don't feel like you've got to write it all out in full. So if you've done both of those and set your statements up, you're now ready to start your question. And at this point, we've scored 4 marks out of the 50 because we've got heading and we've got a structure. Now, before we start actually doing the statements, we need to run down our trial balance and see what goes into each statement. Now, this is something you could actually do in your reading time, because you could just look through it and make a little note of what goes in. So remember, in your debit column, you've got expenses, assets and drawings. Expenses will go in the P&L and assets and drawings will go in your SFP. So if we go down our list here, we've got all of those there going into the SFP. Then we've got opening inventory, which is a profit and loss statement item. And then we've got a couple of SFP items again. And I think the rest of the items then are all profit and loss. All right, so you could get this sort of set in your head during the exam where you're just reading it, trying to think about what goes in each statement. So you must learn those pro formas. You know, what is an example of an asset? What's an example of an expense? What does a liability look like? And so on. Now, the next thing I do is, before I even start reading the notes, is fill those figures onto the statement they belong to. So equipment and premises are both examples of non-current assets. So we're going to copy those numbers straight onto the statement of financial position, and we're going to copy them onto the non-current asset heading. So we're going to have a heading for equipment, a heading for premises. And all I'm going to do is I'm going to write down the cost for each, which is in your debit column, and then I'm going to deduct the depreciation. Now, why am I going to deduct them then? Well, if we look at our trial balance, can we all see that these are debits and these are credits? So obviously we need to net them off against each other. What it's saying is, this is what I paid for these items, but so far that's the amount that I've already written off for these assets. Now, I'm not going to add anything together. All I'm going to do is just put those in the statements, and they're going to move on to the next one. So we've got receivables and payables. So receivables are assets, payables are liabilities. So we've got a current asset for receivables. $84,300. And I've got a current liability of payables. So if you've learned your pro formas, you should be able to tell just by looking at your trial balance what category everything goes into, because you would know what is a current liability, what is a current asset, what's a non-current asset, and so on. Okay, so we just pop those in. Now we do have a profit and loss item next. Let's just highlight those as being SFP. So we've got a P&L item here, which is your inventory. Now, the reason why it's in the P&L and not the SFP is, if we look at the date, it's the opening inventory. Only closing inventory goes in the SFP. The SFP shows your assets and liabilities at the year end. So this was an asset last year, but it's brought forward at the beginning of the next year, so it goes straight into the P&L as your opening stock. So we should know from memorising our pro formas that we expect to see that in the cost of sales. So opening inventory, 51,200. Carrying on down, next item we've got is some capital. So that's going to obviously go in your SFP capital section, and we need to net that off against drawings. Again, it's being netted off because capital is what you've put in the business, it's on the credit side, and a debit means you've withdrawn some money, so you've taken that out of the business, so it needs to be deducted. So show them as separate lines so the examiner can see what you've done here. So brought forward capital just means it's what I started with at the beginning of the year, and then we've got the drawings, which I'm going to show as a deduction. Okay. A lot of questions I'm asked about people, you know, do I have to show it's a debit or a credit on the statements? The answer is no. I mean, once you've done your debits and credits and the trial balance balances, we don't actually care whether it's a debit or credit. We just literally read it off here and say, right, if it's an expense, it goes in the P&L. If it's an asset or drawing, it goes in the SFP and so on. So we don't show it as a debit or credit. We just know it just goes into that category. Now, cash at bank is another asset. It's an asset because it's on the debit side, but watch out because you might get cash on the credit side, and that means that you've got a bank overdraft, right? Because it's a liability. So it's only an asset if it's on the debit side, it's a liability if it's on the credit. So we've got an asset, so let's put that into the current asset section. So cash at bank, 80,600. And then we've got quite a number of profit and loss items to put in. So your sales is on the credit side. That is an example of income when we look at the click rule. And in fact, is the only income that you're most likely to see. So 256,100. And then the rest of the things that we're coming up with are going to be a list of expenses. So we've got expenses for purchases, wages, discounts, sales returns, carriage, and general expenses. So let's fit those in then. So purchases are cost of sales. Purchases means the materials that you're buying with the intention to resell. Wages and salaries are just normal running costs. So they're just going to go in the expenses category. Same for discount allowed. Now we've got some discount received after the discount allowed, and it's on the credit side because you're receiving it. Now this is a type of income, but it doesn't show on the sales line. What it shows is an add to your gross profit. So when we've got our gross profit at some point, we're going to add on 6,900 as some income. You could show it as a negative expense if you wanted to, but that's where you would normally see it, as an add to your gross profit, because it's money coming in, it's not money that you're spending. And then the other expenses we've got, well, we've got a sales return, so that's going to be netted off against our sales. So sales are credit balances because they're income. Sales return is when somebody is sending the goods back to us. So it's a deduction, it's a debit balance. Carriage outwards. Well, carriage is all to do with delivery costs. Carriage out is when you're spending money in order to send the goods out to your customer. Whereas carriage inwards, that we can see on the next line, is still a delivery cost. So it's still an expense, but it's to deliver the goods to you. So that's classed as a cost of sale. All right, you've had to pay for these goods, which cost 136,600, and you've had to pay for carriage, which means you've had a delivery cost on top. So it's all to do with the materials. It's goods coming in, whereas this goes down here because it's goods going out. And then finally, we've got some general expenses. Now, if you've put all of those into the right category, you haven't got half marks yet, but you're not far away. So you can do really well on this question if you learn the structures, if you learn what goes in each category and what the statements look like, just memorising them, then you can score quite well. Now, the next part of the question, probably the other 30 marks or so, will be based on this information. So this is where you haven't accounted for these. Now, you don't have to deal with them in order. If you see one that looks a bit quicker to do, then do that one first. It's entirely up to you. I'm going to go through them in order now, but you don't have to do that. So you've got to decide how to deal with each of these. The first one there, it says that we've got some trade receivables which are irrecoverable and need to be written off. Basically, that means you've got a bad debt. So some of the money that your customers owe you, you're not going to get the money from them, and it's going to end up being a bad debt. Now, if we were doing the double entry, we would debit the irrecoverable debt expense and we would credit the receivables. All right, now you don't have to write that, but what it might be useful to do is to actually think about that so you know where your adjustments are going to go. And again, you could do that in your reading time. You could think about where these adjustments are going to appear. So I've got an extra expense that I'm going to call an irrecoverable debt for 14,000. In fact, I'll tell you what we'll do. Put it in a different colour. So we've got an irrecoverable debt of 14,000. So that's your debit entry, and the credit entry is that you're going to reduce your receivables balance by that amount. Right, so it's saying some of this money needs to be written off because receivables are people that owe you, and if you're not going to collect the money from them, then you need to remove the debt. Now, the next adjustment we've got is one that we see on a regular basis, and this is depreciation. So it's on the equipment, and we want to charge it 20% on a reducing balance basis. Now, I advise you to do some sort of working for this rather than just throw the number in, because if we can sort of see that you've sort of got it right, then you might get some of the marks on offer. Reducing balance means carrying value. All right, so you're going to calculate the depreciation on the carrying value of the asset. So if we have a look up here of what went on with the equipment, here it is. All right, and I'm just going to put a work in over here just so you can see where it's coming from. So the original cost was 129, and so far I have depreciated it by 21,200. So what we need to do is to net those off. So the carrying value at the beginning of the year was 107,800. Depreciation then is going to be based on 20%. And that is going to give me a figure of 21,560. So that's the depreciation for this year on the equipment. And what we're going to do with that, we're going to debit the depreciation expense account, which is what you see in your P&L, and then we're going to credit the cumulative depreciation that you see on your SFP. Now, even if you haven't got the right figure for this, if you make a mistake in the calculation, as long as we can see that you've used your figure in the P&L, you will still get some marks. So that's why it's really important to show your workings. So we've got an expense in the P&L, and then we're going to reduce the equipment by another 21,560. That's your credit entry. It's a credit to the cumulative depreciation, which reduces the assets balance. Adjustment number 3 is still depreciation, but now we're looking at the premises. Now this one's easier because it's 5% on a straight line basis. Straight line means it's based on the cost of the asset. So it's the same charge every single year based on what you paid. So if we go up here to the premises, and again, just do a little working up here. Your workings I'll probably do on a separate sheet of paper so it all looks a bit neater, but I'm trying to show you where things are coming from while we're looking at the numbers. So the premises cost 450 and we're going to charge 5%. So it's different. You must know what the difference is between straight line on cost and reducing balance when we net it off. It's a different way of calculating the depreciation. So that gives me 22.5, and the entries will be exactly the same as what you did here. You're going to debit the depreciation expense and credit the cumulative. So reduce the asset by 22.5, and then a separate calculation to show the expense in the P&L. Closing inventory then, this is a nice easy one. We don't really have to calculate anything for that. We just need to know where it's going to go. So we are going to debit the inventory account and credit the cost of sales. So it's saying of the goods that we bought during the year, some of these we have still got in the warehouse. So closing inventory, we're going to reduce the cost of sales. And we're going to put it in the SFP. So the SFP only has closing inventory. It doesn't have all of your inventory. And the final one that we've got here, we've got an accrual and a prepayment. So salaries are owing. Owing means that we've got an accrual. So that means we need to increase our expenses. So we'll increase salaries and credit the accruals account. The accrual is your liability, the amount that you owe. Whereas the prepayment, which is your general expenses, that means you've paid something in advance. So if you've paid it in advance, that means you're going to credit your general expenses because you've paid more than what you need to, and you're going to debit your prepayments. Okay, so let's put those in as the last items. So let's do the accrual first of all. So debit the salaries, we need to increase the salaries, remember. We've got to increase them because it's owing. So this here is what we physically paid, but we still owe some more money. We can't ignore it just because we haven't paid it. A profit statement is not a cash statement. It's a statement of what the expenses were for the year, not what you've actually paid. So we're going to increase the wages and salaries, and then we're going to create a liability here for the wages of 5,400. And then similar thing for the prepayment. We've paid this in advance. So some of the general expenses that we've got in our statement here are towards next year. So we need to take those out. So we're going to reduce the expenses and create a prepayment which shows in the current liability and current assets. Now, I know it doesn't look very pretty the way that I've wrote it down, but I've wrote it this way so you can actually see the logic of the two sides of the entry. So you can see that everything in the trial balance only appears in one of the statements somewhere, and that everything that you do down here appears in two places, usually in the two different statements. So show some sort of track. You know, you may not write debits and credits because you don't have to, but show something in your workings like I've done here, some sort of logic so we can see where everything's come from. So the final thing we need to do then is tidy it all up and add it together. So if we start at the top with a P&L, so sales less sales returns gives me 243,600. Now if we look at the cost of sales, it's the cost of the goods I've sold. So I've got my opening stock plus my purchases plus my carriage, and then I'm taking out the closing inventory because obviously I haven't sold those and I want the cost of what I've sold. So if we add that together, that gives me 127,700. Now some people show it as a bracket. You don't have to, but what you do need to know is that when you're working out gross profit, it's your net sales minus your cost of sales. So it is actually these two figures here. So it's your 243,600 minus your cost of sales. So if you net those two off, you will get a gross profit of 115,900. So gross profit means trading profit. For my main activity, that's how much profit I've made. The discount received is a type of income, so that gets added. The only other thing you might see there might be interest received or rent received, but you don't get much happening after gross profit that's an income. Finally, we've got our expenses, so we just need to add these across. So original trial balance plus the accrual here gives me 60,700. Discount allowed is obviously the same, carriage is the same. Expenses, 37,400 on the TB minus the prepayment gives me 21,900, and then the other items we just copy across. So finally your net profit will be your subtotal here, so your 122,800 minus all of those expenses. So again, if you want to, you can put those in brackets, entirely up to you, but you've got to deduct all of these here from the 122. And a lot of mistakes students make is that they add them. Now here we actually end up with a negative, which can happen. So actually it's not a profit, it's a loss, because my sales are less than all of my expenses. Now when you've got this figure, it's important that you remember that goes into capital. So if it's a profit, it's going to increase your capital. If it's a loss, it will reduce it. So this is what the owner's got for all the hard work during the year. So I'm going to add that in. So we've got a loss, put in brackets there from P&L, and it's 24,360. So I'll highlight that so you can remember that that's actually where it's come from. So finally then, let's add up our SFP. So we're going to add up all assets, so non-current, add them across. So total non-current assets we've got is 463,140. For your current assets, we've got your receivables minus your bad debt. So that gave me 70,300, plus your cash, plus your inventory, and plus your prepayments. Now, you're probably aware that these should be in a particular order. So in applied accounting, we do teach you to try and put them in order of liquidity. So ideally, we want to see inventory, receivables, prepayments and cash. But as far as IFA goes, I'm not going to mark you down for that. As long as they're in the right category, that's all I really want to see here. So in total, then they come to 232,500. And if we add those together with the non-current assets, you should get total assets that add up to 695,640. So for the final section, add up your capital. So you've got your opening balance, it's reduced by drawings, and it's also, in this case, reduced by the loss that you've made. So at the end of the year, your closing capital balance is worse than what you started with. We haven't got any non-current liabilities, and to be honest, the only thing you'll see in there is if you've got a loan that's around for more than a year, so not an awful lot goes in that category, and we haven't got any loans here. And then we've got a couple of current liabilities that add up to 81,400. So if we add together our capital and our current liabilities, then we get 695,640. So that's your total capital and liabilities. And if I zoom it out a little bit more, you can see that those figures do in fact agree. And that's how we know we've done it correctly, because it should balance. The assets, remember, if you go back to your accounting equation, assets should equal capital and liabilities. So everything that you've got in your business as a resource either belongs to the owner or it's got to be paid out because you've got some sort of debt. So hopefully that debrief has given you a good idea of how to structure this first question. Most of you on a resit will have already attempted the first exam, so obviously your marks are capped at 40. And I think you could easily do that with just this first question, or almost have passed on this first question if you practice it. But the key is learning what all the different items are, where they appear, which category of which statement they appear, and then once you've done that, working on those main types of adjustments.